What's up, folks? Week 11, is everybody, how are you feeling about week 11? I personally was kind of thinking about uh, that week 11 has got some interesting implications for it. It doesn't feel like it should be week 11 already, but on the other hand, I'm ready for Thanksgiving. So I don't know if that's the way everybody else feels. I remember saying, and this has been more profound in the past few years, but I remember saying during the pandemic, especially during the year after the pandemic for the year, it was simultaneously the longest and shortest time period that I'd ever experienced in my life. And that's kind of how I'm feeling about this semester. It's going by quickly, but not quickly enough. I don't know. Anybody else feel that way? Because you're like you want it to be over, but then you're looking at the end of semester saying, I've got so much stuff to do by the end of semester. I hate to pile on, but I've got some announcements in that regard. So first and foremost, let's talk about some stuff that's not auditing related. So I don't know if this has been circulated around, but if you are planning on being in one of the programs, either graduate or still undergraduate next year, you might want to take a look at the MOCPA website. They've got some scholarships that are up and available. We've had one student who's traditionally applied and received the scholarship. I don't know how many people have been receiving, but they're really nice. They're, I think, minimum 500, and the max end is $1,000 scholarships. So, and it's just an application you have to fill out. And I think that we could have more trim and applicants that could be associated with that. So something to consider. Also, if you're still looking for employment over the summer, like you're looking for an internship, I was on Handshake earlier today. They've got a bunch of place or openings on Handshake to open up for. So I would definitely recommend looking at those. There's one for Enterprise Bank and Trust that I thought was really interesting, and part of that is because it's a former intern of mine that's coordinating the search. It's actually my intern from the 2017, 2018 year. I think that's right. Maybe it's 2018, 2019. But he actually was I'm very fond of my I said intern, I meant GTRA. I'm very fond of my GTRAs, and my this one was one who worked really hard, and he helped me out a lot with my research. So doing what I can to help him out. He's a good guy. He was actually on the baseball team that was at the World Series back in, I think, 2014, 2015. And so former student athlete. Anyway, think about looking into those, especially if you're looking for a job opportunity for the summer. All right, so real quick, some things that we need to be aware of. It is what, the 20 something, the 26th today? Is that right? Or 27th, 27th. So that means it'll be the 31st on Friday, which I do have a Halloween costume, by the way. So I'll wear that. Yeah, get look forward to that. Yeah. But it'll be Halloween, and then 1 week after that is the 7th. On the 7th, we have our Excel assignment to do. If you have not started working on that or even started looking at that, I would recommend that you do that now. We did encounter a bit of an issue with one of the companies, so I would recommend that you look at the companies and make sure you can access the financial data. A little bit of story. One of the companies, we actually checked, my GTRA check to make sure all the companies are available on Morningstar. He did this right at near the end of August, and then right at the end of August, the company got acquired by private equity. So so I want to make sure that doesn't happen to anybody else. So please make sure you investigate that. But yeah, you do need to devote sufficient time to the Excel assignment. It is not hard. It is time consuming. Okay. If you try to do this in a few days, you will likely not be successful. If you do this right before class, you will definitely not be successful. Okay. And I will tell you, this is the one that this is kind of my gold standard for the course, is that I do insist on a 15 out of 20 on the Excel assignments to opt out of the final exam. If you score a 14 out of 20, you will be joining me during finals week. Okay. So please take this seriously. Professional interactions due the week after that. We do have a few activities that are coming up this week and next week. So we've got our TrueBiz forum on Wednesday, which I think is actually going to be a really sweet one. It's going to be on AI. So if you want to attend that, that's something you can do for your professional interaction and learn about AI at the same time. It's a win-win. And then we've got something in the entrepreneurship lab next week. I think it's next Wednesday. I don't remember exactly the date, but it's next week sometime. But if you've already visited and had an opportunity to do that, great. If you've not, please make sure you take an opportunity out to do that. Finally, I wanted to really quickly debrief on the exam because I ran out of time because I was having so much fun talking to you all that I did not have a chance to do my normal spiel. So I wanted to reiterate two things. First of all, I was fine with that the performance on the exam. I did add 3 points to everybody's score on the scores that were online. That had primarily to do with that audit question. They won on whether or not you identified the the audit committee language that was in the audit report. I think most people in the class missed that, and I kind of felt a little bit bad about that. I'm not saying you shouldn't know it, okay? I'm just saying that I felt bad about it, okay? So I added that back. I think that a few people were really, really worried about their grades. Keep in mind that your final grade, if you opt out of the final exam, is based on your two highest exams. So even one bad exam is not going to preclude you from doing well in the class. That being said, you probably want to take real care and rigor focus on the final exam, or the third exam, I should say, to make sure that you get what you need in the course. If you have any questions about that, I strongly encourage you to come talk to me and make sure that you understand what it is required of you. This is a chance for improvement. The great news for everybody in this room is, even though I personally consider the third exam to be the most difficult of the exams, it's also the exam that most everybody does well on that. I don't have an explanation for it, why the most difficult exam is the one that everybody does well on. I think it's just because everything kind of comes together and it becomes a lot more intuitive after we've seen all the topics at one time. I'm not telling you that so they say, oh, last exam, the third exam, that's the easy one. I don't have to study for it. You very definitely have to study. There is a lot of material that you're going to be responsible for, but I want to reassure you that it's not going to be the blowout that you're worried about. Okay. Traditionally, students have done really well on it. So as long as you keep keeping up and keep doing what you're doing, I think you'll be fine. All right. So today we're going to talk about auditing the revenue process. This is going to be a first of our business process areas. To be clear, we're going to talk about multiple business process areas, but I think this first one and the one we're going to talk about on Wednesday are by far the most important, because we're going to talk about revenue and we're going to talk about purchasing. And just like we talked about in AIS, they're going to be mirror images of one another. So a lot of the things we're going to be talking about are going to be redundant because we'll have already talked about it. But we do want to take a deeper look in understanding what it is that we have to know from the audit perspective. Now, the first question is that I'm going to ask you is a very basic question. And there's a bunch of different ways to answer this, but I do want to preface this by saying that I do have some aggregation that I do want you to take part in here. So when I say, what is the revenue process? I think, and there's a number of different answers for this. And I'm not asking, this is more of a rhetorical question of what the revenue process is. Specifically, what are the components of the revenue process? And if we think about this from an accounting perspective, there's basically three distinct phases that we could identify. There's first of all the sales step, okay, which I think is fairly intuitive. You can't have revenue without sales, at least for the most part. I guess in some entities, like you've got a not-for-profit where you say you get donations, you could generate revenues in that regard. To be honest, those aren't traditionally viewed as revenues, but more as contributions. But it's going to be sales, and the next step is going to be the cash receipts. This is going to be the business-to-business environment that we alluded to back in AIS. This is going to be something that's traditional. Not all entities operate on this, but we're going to assume that most of our entities that we'll be auditing will. So in a business-to-business environment, there's an extension of credit. So there's going to be a subsequent collection of cash. And then there's going to be returns and allowances, which is something that we kind of overlook, but a really important step. Now, the good news is the auditing steps for that are not really, really critical or difficult, but we do have to consider that as part of our process. So overall, the business process of an interview is going to be integrated. This is a diagram for the book, and I think it's a good summary of the transactions. You are not responsible for knowing this diagram. This is not going to be on the exam. This is just mostly for your context, understanding all the business processes we're going to be talking about. It is going to be more than the three that we talked about in AIS. We're specifically going to talk about, I think it's like 5 in total, because we're also going to add in payroll and human resources, and then we're also going to talk about financing and investing. The reason why it's a little bit harder to distinguish those is those are more general. They don't have specific steps and they integrate very heavily with others. But like I said, the most important ones by far are the ones this week. In fact, this week is going to be the one that everything should start aggregating. You should basically say, all right, now it makes sense. All right. That being said, I'm going to leave a lot of information out, and it's going to be your responsibility to do some of the work on your own. Okay. Part of that is because I just don't have the time to cover it all in class. So when I stop and say, make sure you review this on your own, study this on your own, it's a really, really critical protocol that you follow that. All right. Revenue recognition. Revenue is defined as inflows and other enhancements vast as an entity of settlements and liabilities or a combination of both from delivery of producing goods, rendering services, other activities that constitute the entity's major or center operations. That was 200%, right, Michael? Yeah. Yeah. Okay. All right. So revenue, pretty easy definition. Okay. I think that everybody understands this from a context. We're not too concerned about the technical definition or the technical context for revenues, but we do think that I do think we need to understand about what recent occurrences have. And I say recent as relative. Back in 2014, a accounting standards update was introduced called Topic 606, Revenue from Contracts with Customers. And this should be something that you're already familiar with. I'm sure you discussed this back in 302. The idea being is that we need to have a series of criteria for how we recognize revenue. And there was going to be a single recognition model. Now, why is a single recognition model important? The answer is before this standard, when I say 2014, this is when it was introduced. It was not passed until like 2017. So even though I know that you're saying that's not recent, Dr. Barnes, that's like 8 years ago. Come on, give me a break. 8 years is not that long ago. Okay. So even though we're talking about something that's only 8 years ago, it does bear emphasis on the difference between the way revenue recognition used to work and the way it is now. The way it is now is that every organization has a similar series of criteria. Didn't used to be the case, is that different organizations recognize revenue differently, particularly across industries. Industries were very disaggregated. So the one recognition model basically says companies should recognize revenue as they fulfill their promises to provide goods and services to their customers. Which that doesn't seem like a very profound statement to anybody, but I think that's pretty intuitive, but it works differently for different organizations. If I go back to our old standby Taco Bell, when does Taco Bell get to recognize revenue? When they deliver you the Mexican pizza or the chalupa or whatever it is you order from Taco Bell. Is there one product that I've never mentioned that anybody's like, this is what I ordered, Dr. Barnes. Why don't you ever talk about that? Everybody's gonna say tacos, Dr. Barnes. Come on, you never mentioned tacos. Let's see, it is Taco Bell after all. So yeah. When they actually deliver the product to you, all right? Is that the way it works for other organizations? Like if we're talking about an organization like I don't know, like Earthware Clothiers, okay? Is Earthware Clothiers the same situation? Largely because they're business to consumer. What if we have a business to business environment that delivers goods to the customers but don't actually accept cash? Is that a different recognition system? Well, not really, because we recognize it whenever the performance is met, whenever you deliver the goods. Remember back in AIS, we talked about when revenue recognition occurs in the business process model notation diagram. It's the same idea, is that whenever you meet your performance obligation, you actually recognize it. And it becomes a little bit, this is a pretty straightforward context, but it makes a little bit, gets a little bit more shady when you start thinking about larger organizations. Like, for example, let's assume that you're building a skyscraper. Okay, it's going to take you 10 years to finish the building. When do you recognize revenue? When the building's completed? That's probably hard to go for 10 years without revenue in your organization. So yeah, that might be a little bit more challenging. Something a little bit smaller. What about Boeing? When does Boeing recognize the revenue on an airplane? Do they recognize it when they finish building after like 2 years? Or do they recognize it on a monthly basis when they meet certain goals? The answer is that it really depends on the situation. It's our traditional accounting answer. It depends, okay? It really depends on the organization. So guidelines for revenue recognition. These are not really critical to understand, although I think it's good to have a basic framework for it. So principles are consistent across industries. We have a cohesive set of disclosure requirements. We include variable consideration on the transaction price. We identify distinct performance obligations, which you should remember that term, performance obligations. That's what measures revenue recognition. And then we allocate transaction price to performance obligations. So this sets up our steps for revenue recognition that you should remember from 302. Now, I'm going to tell you right now, this is not a financial accounting class. I don't hold this in high regard, but I still think that you should know these because you're accountants and you should actually know the revenue recognition guidelines. So what's the first step? Identify a contract with the customer. This is where we bring the lawyer in and say, does a contract exist? Is there actually commensurate exchange of goods? And is there consideration on both parties? The answer is yes. We move on to part two. Identify the performance obligations of the contract. What do we have to meet? What do we have to accomplish to recognize revenue? For Taco Bell, it's easy. You got to give them the taco. For Boeing, it's a little bit more difficult. Okay, we've got to finish the fuselage, something along those lines. Next, we determine the transaction price. Okay, what is the price for the entire transaction, not individual components, because we need to know what the whole is going to be. Then we allocate the transaction price to the performance obligations of the contract. Again, this changes depending on the nature of the contract. If it's a contract to Taco Bell, it's taco is the entire performance obligation. That's the entire transaction price. If it's Boeing, it's fuselage, wings, cockpit, then the seats and everything inside. Basically, every single component, it could be identified at different points in the transaction price. Okay. Finally, we recognize revenue when the entity satisfies a performance obligation. So you meet a particular step, then you actually move on to the next point and you say, that's where we recognize revenue. We can move on to our next performance obligation or accomplishing our next performance obligation. So understanding this is really, really critical for financial accounting, but we haven't really gotten to auditing yet. What do we need to know from the auditing perspective? This is where things start taking off. So the first thing I want to talk about is I want to talk about the idea of fraud related to revenue. Now, quick question. It's a rhetorical question, but it's a really important one. Has revenue fraud ever taken place? Yeah, it's only been a few times, okay? I'm being facetious. Revenue is a very, very prone area for fraud, particularly when we talk about financial reporting frauds. Revenue misstatement is really problematic. In fact, I would say the majority of financial reporting frauds have to do with revenue manipulation. Not all of them. We're going to look at an example on Wednesday of one that took place with purchase manipulation, but it's very common that this takes place. So what are some things that we need to think about when we think about fraud risk related to revenue recognition? We're going to talk about four that are kind of very general. This is not an inclusive list. This does not cover everything, but these are the ones that I want you to be accountable for in this course. First one is going to be side agreements. And a side agreement is basically encouraging a separate party to engage in a transaction that they would not otherwise engage in without some sort of coercion. Okay. So example of a side agreement is that you are responsible for sales, generating sales in an organization. You reach out to a vendor and say, all right, would you purchase this from us? And they say, no, we're only going to sell to you. We don't have no interest in buying. I said, okay, what if I make an arrangement that we will purchase we will purchase premium goods for you if you buy some goods for us? That is engaging in a contract that normally would not be normally not be feasible and not be viable. Basically, it's kind of a saying, you do something for me, I'll do something for you. That's how the side agreement contract works. There's an example of a side agreement in the book that actually provides a little bit more explicit detail if you want to read that on your own. But I do think this is an interesting area of revenue recognition or revenue manipulation. One that's a little bit more common is something called channel stuffing. This one's very prevalent in fraud. So imagine for a second that you've got you're up to the very end of your fiscal year and you're a salesperson and you're saying, all right, I'm not going to get my bonus unless I generate another 2,000 in sales, but I've got like literally 15 minutes left in the fiscal year. Could you say you're out of luck? Well, you could say, well, what if I create some fictitious transactions? Normally fictitious transactions would be problematic, but what if you say, I'm going to create fictitious transactions that I know that my customers are going to send back to me and say, I didn't order. So you do those in the last 15 minutes of the year, you create $2,000 in fictitious transactions. And then on January 1st, your customer says, yeah, I didn't order this. And they say, oh, we're sorry, ship it back. You recognize the revenue on January or December 31st. You recognize the refund back on January 1st. Did everybody see the problem with that? Revenue's inflated in one period and gets reduced in the second period. That in a nutshell is channel stuffing, okay? The real problem, especially if we don't timing. By the way, you're going to notice that there's a very, very critical assertion in this area, one that we're going to have in our homework multiple times. This is going to be our cutoff assertion. This is where cutoff comes into big play, making sure that we understand the timing of transactions and whether they're appropriate. Next one is going to be one that we're familiar with. These are related party transactions. So related party transactions is basically where we give favorable terms to parties that have pre-existing relationships. So revenue recognitions can certainly be problematic, especially if we give favorable terms to parties and they're buying from us and they're not necessarily at arm's length. So say you've got your father is buying stuff from you and say, you know what, because you're my father, I'm going to give you a 50% discount. The question then arises, do you give everybody 50% discount or is this just one party? And that's certainly problematic because if not everybody's getting the same discount, then you're not negotiating at arm's length. So that'd be an example of a related party transaction. And then we have bill and hold sales as the final one, okay? So bill and hold sales, basically this only exists when there's pre-existing contracts with the customer. But let's say that I've got a customer that has a contract to buy a certain amount of goods from me every single month at the 15th of the month, okay? So they buy on January 15th, February 15th, March 15th, so on and so forth. I'm in my same problem. I'm at December year end. And I know that I'm not going to make it. I'm going to be $2,000 short, but I see a customer that buys every single month on December 15th or January 15th. And I say, well, I'm just going to go accelerate the recognition of that revenue to this month, and I'll hold the goods for them until I ship them out. So I'm going to recognize the revenue current period. So that's an example of bill and hold sales, which everybody's screaming foul right now because that violates one of our primary accounting principles. That's going to be our conservatism principle. All right. It also violates revenue recognition principles because we've not met the performance obligation to recognize the revenue. We've not shipped out the goods. But conservatism says that we delay the recognition of revenue, accelerate recognition of expenses. In this case, we've done the opposite. We've accelerated recognition of revenue, which is a big no-no. So that's why we have a problem with bill and hold sales, but it happens more frequently than you might think. All right, moving on. So a retailer, which is going to be kind of our template for analyzing this course, there's two different ways that we can engage in transactions. This is the simple one, okay? This is our Taco Bell example, all right? So Taco Bell is really more of a manufacturer, but this is what I'm going to use it as. So a customer makes a purchase, we remove it from inventory, recognize it a cash sale. Our the one that more facilitating is going to be our credit sale, and this is going to be the one that we're going to use kind of as our standard for transactions in this course. This is basically where we extend credit to a customer. We recognize the revenue when we meet the performance obligation, but that's separated from the cash receipt. This is really important to understand because this leads that we're going to have two separate steps in our process. We're going to have the recognition of revenue or the recognition of the sale, and then we're going to have the cash receipt, which both have their own risks associated with them. So we as auditors have to recognize that not only are there going to be two process areas, but there's going to be separate controls and considerations that we have to have for each process area. Now, you may be saying, Dr. Barnes, hold on a minute. You said there were 3 steps in the revenue process or 3 consideration areas in the revenue process. I promise I'll talk about the third one at the very end. The good news is it's not that big a deal, okay? But let's go ahead and talk a little bit about what our framework for this next few chapters are going to be. For the next couple of chapters, we're going to use this framework. We're going to be talking about types of transactions, the financial statement, accounts effective, the types of documents, records, the major functions, the key segregation of duties. Now, I'm not going to tell you that this is a perfect template for understanding. I'm not going to say that you're going to walk in out of this course and you say, I now know everything about revenue. Yeah, if you do feel that way, I'm glad I've inspired you, but that's not going to be true. It's going to be a little bit confusing, but the repetition of this and the simplification of this should hopefully make a little bit more sense, okay? I'm just trying to tell you that what I'm going to tell you is not going to be perfect analogies in every situation, but this is the most effective approach that I know of to approach these particular issues. All right, so first of all, transactions that are the revenue process, we've already talked about these. We've got our sales transactions, the rendering of goods for cash and credit. Please make a note, when we talk about the sales process, this is where sales discounts would be accounted for, okay? These are not going to be a big part of this particular course. There's not going to be a lot of focus on discounts or allowances, but I do want to make sure that we have a delineation of the different types of discounts. So what's an example of a sales discount? So that would be like you're shopping in the department store and normally something's priced at $19.99, but if you buy it today, it's $15.99. That's an example of a sales discount. It's an upfront discount. You make that purchase. So that would be actually a reduction on the purchase, a straight up reduction on the purchase price as a sales discount. Next is going to be receipts of cash from customers and payment of goods or services. This is pretty obvious. If we extend credit, we have to subsequently receive cash. If you're in an organization where you extend credit and don't get the cash back, your organization is not going to be in business for very long, okay? So cash collections are the lifeblood of organization. Also, you will note here that this is going to be the point where we actually have a different type of discount. This is where cash discounts occur. What's the difference between sales discounts and cash discounts? Sales discounts, as I said before, are upfront discounts. Cash discounts are those funny things that we talked about in AIS, like the 1/10, N/30. This is basically an incentive for early payment. So we say, we're going to give you a 1% discount if you pay within 10 days. Otherwise, you have to pay the net balance within 30 days. These are separate from sales discounts. This is more about a discount on payment rather than a discount on purchase. And then we have our third area, transactions, returns of goods by customers for credit or cash, okay? So the returns of goods are very important as well because these do reduce the receivables amounts that we can recognize. So an organization cannot achieve a receivable if they have a return in there. There's a few notes to make on this as well, okay? So this is where our allowances would be included as well. This is where our allowances, so sales returns and sales allowances are both included. Now, does anybody know the difference between a sales return and a sales allowance? So a sales return is pretty obvious. Sales return is like, I don't want this good. I'm taking it back to wherever I bought it and returning it for cash or credit, okay? A sales allowance is very similar. You say, I did not want this, or this is not up to my standards. I'm not going to return it, but I'm going to get a refund on it. Now, why made a sales allowance exist? You say, that seems unfair. They still receive the benefit from it. There's 2 common situations this occurs. First of all, if it's an extension for services, like if you've got a janitorial service that comes in and they clean and say, you know what, you didn't do a good job. And they say, oh, okay, we're going to go ahead and refund the money that we charged you. We're also going to dump all the dirt out that we vacuumed up so that we can actually make sure that that's the case. But that's good. That actually wouldn't happen, okay? You would still get the benefit of the service, but you wouldn't pay for it. The other situation is usually with perishable goods, okay? This comes up very frequently with restaurants. So you order a pizza from Domino's and they send you a disgusting Hawaiian pizza, okay? Unless you like Hawaiian pizza, that's what you ordered. If you are, what's wrong with you? I actually don't have a problem with the pineapple. It's the ham. That's what gets me. Okay. But yeah, the ham, I just don't like ham on pizza. I don't know what it is. Just doesn't seem to make sense. I'm just not a big fan of ham in general, though. Which is funny because I like hamburgers, but yeah. Yeah, I'm getting way off track. So yeah, you basically say, I didn't order this Hawaiian pizza, instead I ordered a pepperoni pizza. So, oh, okay, well, they're not going to require you to return the Hawaiian pizza because it's not going to be good for consumption anywhere. Instead, they're just going to set ship you out a new pizza. This also leads to an interesting point. That's what the sales allowances. So I do want to make a note of this, and I think I probably talked about this in AIS, but if I have, forgive me. If you order something on Amazon that's perishable, like you order a perishable good that has an expiration date and they send you the wrong good, you are not required to purchase that good. Okay. They will try to get you to purchase the good, but you'll say, no, no, I'm not interested in purchasing it. Then they're going to say, all right, well, you can't return it because it's a perishable good. So you just keep it and we'll ship out the right good for you, or they'll give you a refund. Okay. I know that seems really, really devious, but keep in mind that it is a perishable good. It's their responsibility to send out the good perishable goods. The reason I know this is because when I was filling the snack cart back about 4 years ago, I was ordering exclusively off Amazon, and I kept trying to order. Kept trying to order Sun Chips. Sun Chips were going on the snack cart all the time. It's like the 1 ounce bags of Sun Chips. They kept sending me the wrong sizes all the time, and every single time I'd say, "Please ship me out the right ones." Okay, would you like to purchase the ones we sent you? We'll give you like a 20% discount. And I was like, "No." They said, "Okay, you can keep the goods." All right. So anyway. Told you how to be devious. All right, that's good. All right, so with respect to the transactions and sales revenue process, these are fairly intuitive, okay? Now, there is a little bit additional one where write-offs. This is going to be when we don't collect the cash and the cash receipts transaction. Hopefully this doesn't occur very frequently. If it does occur frequently, we've got a problem, okay? So that's going to be my only note about that. We don't consider that as a separate transactional area simply because it should be fairly infrequent in the organization. But for most of these are going to be pretty straightforward and intuitive. There's not a lot of difficulty in interpreting this. We will see some difficulty in interpreting some of the other ones. We're going to have a similar table of this in our other business processes, and you're going to say, hang on a second, Dr. Barnes, that doesn't make a sense with the process. And we're going to talk about why it's included in those areas. But I don't think anything up here is very, very difficult. If I were to say, what are the components of a sales transaction? Hopefully you know that it's going to affect accounts receivable, sales, allowance for doubtful accounts, and in some situations, the bad debt expense. Well, actually in all situations, because it's usually a percentage of sales. But yeah, that should be fairly straightforward. I included this up here for reference. I don't really focus too much on the documents that are included in here, but you should have a pretty good understanding of the documents that would be included in the revenue process. Again, I'm more concerned about your general understanding of the revenue process, about what you these. We could go through these in detail, but I'm not going to ask any questions on the specific documents. What I will ask questions on are the major functions of the sales process, okay, the revenue process. So order entry, credit authorization, shipping, billing, cash receipts, accounts receivable, and general ledger. Now, it's important to note that these first 5 steps are fairly straightforward. We would think about these if we're talking about a sequential process. Accounts receivable and general ledger, these are mostly redundant steps that affect different parts of the recording, okay? But what I'd like to do is I'd like to look at these and I'd like to do a little bit of a chore. So something I'm going to approach, or the way I'm going to approach these functional areas is I'm going to tell you that for the most part, not entirely, but for the most part, these will all represent different areas of responsibility with respect to segregation of duties. In other words, somebody who has a responsibility in one area should not have a responsibility in another area that has a separate segregation of duties responsibility. But in order to do that, we need to define what area of segregation of duties do these represent. So let's do this for each of these, okay? So we're talking about order entry, okay? Order entry, by the way it sounds, what does that sound like with respect? Is it C, A, or R? Recording, it's R, okay? It's a recording function, okay? Now, credit authorization. Is that C, A, or R? So if anybody says C, I'm going to throw something at you. Authorization, A, authorization, okay? Authorization of transactions, okay? So obviously we're starting out here. Whoever's responsibility for order entry cannot have a responsibility for credit authorization as well, which makes sense. You don't want the people making sales to be the same people authorizing the transactions. What are they going to do? They're going to authorize all their transactions so they increase their commission, okay? That's going to be a really important note to separate out. Shipping, okay? Shipping of goods. When we talk about goods, we're talking about inventory. Inventory is an asset. They have custody of those assets, okay? So shipping is going to be a custody step. Now, billing, all right? The issuance of sales invoices, okay? Now, sales invoice is a document. What do we do with documents? How would we actually approach that step? We would record the document, okay? So it's a recording function. Now, I want you to make a note of this. We're going to talk about this on Wednesday. We're going to see a mirror image of this process on Wednesday. This is the one step that does not align with that process. We'll talk about why, but for the most part, everything's going to align on Wednesday except for this step, okay? When we talk about invoice processing on Wednesday, which is the counterpoint to this step in the purchasing process, it will not be a recording function. It'll be something else, but we'll talk about that here shortly. Cash receipts, okay? So cash is an asset. So if we're talking about cash receipts, this is a custody because we have custody of the assets, okay? And then accounts receivable and general ledger, like I said, these are redundant functions, but they affect different parts of the system. Accounts receivable is affecting subsidiary ledgers, general ledger is affecting the general ledger, but they're both recording functions, okay? This is a little bit confusing, and we'll talk about why in the next window, okay, the next slide. But for the most part, I think that this approach to these particular functions is very helpful. So make sure that you're clear on there's different responsibility areas. Now, could there be other responsibility areas contained within these? Like, could you say, well, Dr. Barnes, what about billing? Could we have an authorization step in billing? The answer is absolutely yes. I'm talking about the large part of the steps. So the large part of these functional areas are going to be focused on those primary areas. So billing is mostly a recording function. Could there be steps into their authorization? Absolutely. It's not a perfect analogy, but it makes it much easier to understand if you think about it as being a recording function. All right. Does everybody understand? This is not perfect. I'm not going to say I know everything. Now we can never do any authorization and billing ever. Okay. I'm not saying that. I'm saying for the most part, for our understanding, it's going to be easier to think about as a recording function, full stop. So if we have this, then we should be able to segregate duties effectively. So let's go ahead and walk through a couple of these to talk a little bit about this. So the credit function should be segregated from the billing function. When we talk about the possible error, basically, if we have credit that's segregated from billing, you can have somebody who makes sales to customers who are not creditworthy, which is a really big problem because if we're not creditworthy, they're not going to pay us the cash that they owe us, which means the organization's not going to be in business. What do we say credit function was? What was the area of responsibility there? Authorization. What do we say billing was? Recording. Does it make sense that those steps should be segregated? Yes. Okay. So those were segregated. I want to move down to the third one here. Shipping function should be segregated from the billing function. Okay. So if you have shipping from the billing, then you can authorize shipments to be made for billing procedures to be circumvented. This can result in unrecorded sales and theft of goods. Shipping we said was what? Custody. And we said billing is recording. So again, a separation there. Now I do want to make a note of this. I included this table because it's in the book. But you'll read here, it says accounts receivable function should be segregated from the general ledger function. And I just said that these are both recording functions. I do not believe personally that these are true segregation of duties, okay? I think that they're redundant recording functions to make sure that if an error occurs in one spot, it does not replicate itself in another spot. This is what they mean by segregation of duties. But by definition of segregation of duties, it's not separation of those three items. It's just two different areas where items are recorded, okay? So you can largely ignore this one. It's not true segregation of duties, but I do think that it's important to understand how segregation of duties exist for other areas within. Is everybody clear on that? It should make sense, a little bit more sense once we look at the functional areas and kind of separate those out. It should make a little bit more intuitive sense. All right, starting out a inherent risk assessment. Four specific inherent risk factors that can affect the revenue process are industry-related factors. So industry creates volatility in many organizations. We already know that the entity and its environment is the primary reason for inherent risk. The complexity and contentiousness of revenue recognition issues. Certain industries have more contentious revenue recognition than others. If we're talking about a retail industry, it's pretty straightforward. If we're talking about oil and gas, well, we already know the problems that Enron had with their mark-to-market issues, and they created a lot of problems with that. So it can create a lot of inherent risk if we just from the nature of the industry itself with respect to revenue recognition. The difficulty of auditing transactions and account balances. So kind of linked to the previous point, trying to audit certain transactions can be really, really difficult if those transactions are very opaque, if they're not very transparent. Has anybody ever looked at an oil and gas accounting transaction? I used to audit an oil and gas client. If you asked me what was going on there, I still couldn't tell you, okay? It's just really, really weird accruals and then a reversal of accruals that take place and the numbers do not match and you have to figure out how to match things up. It's just really, really weird, okay? It causes a lot of problems. And then finally, misstatements detected in prior audits. This one's pretty straightforward. If misstatements occur in previous audits, then we're going to be suspicious moving forward that misstatements might occur also, because it's not necessarily that the individuals have changed or that the controls themselves have been fixed. All right, with control risk assessments, I'm going to tell you right now, okay, so let's go ahead and get this out of the way. We're going to be operating on a reliance strategy for the next couple of weeks, okay? I know those of you who are looking forward to the substantive strategy, and I promise it's coming, okay? I promise it's going to be here. It'll be here in week 13. We'll have a reliance strategy or substantive strategy item. But unfortunately, for the next 2 weeks, we're going to be on a reliance strategy. And the reason why is pretty straightforward. If I gave you the option of auditing the controls surrounding revenue or auditing all the revenue transactions that existed, which would you choose logically? The controls. There's far fewer controls than there are transactions, okay? That's going to be one of our primary criteria. So it makes sense to make sure that if the controls are trustworthy, that we can get a lot more assurance over the revenue process. So we're going to use a reliance strategy here, and that's not going to change for the next few weeks. We're going to perform and plan and perform tests of controls on revenue transactions and set and document control risk revenue process. Now, is there possibly an environment where we could use a substantive strategy for revenue? It could exist. The only feasible scenario that I talk about is if controls are just completely non-existent. You have a small organization where they don't have controls in place over revenue, which that's a big risk already. Or if you had a particularly weird organization where they only have 1 or 2 massive transactions per year. Okay, it's very, very nuanced. It's very unlikely. So we're going to talk about the majority of most of our scenarios here. And this is going to be where we're at. All right. So remember, we're talking about test of controls. We're talking about assertions over transactions and events, which is going to be our focus. So it's everything but rights and obligations. We're still going to use all these assertions again, but we're going to flip our focus to more on account balances when we get to transactions on account or to assertions on account balances. But we'll talk about the intuitive difference between that here shortly. All right, so control sequence. Everybody feel comfortable with this? I kind of ran this down your throat in the previous exam, or for the previous exam, but it's important to note because this is going to set the template for how we test controls here. And it's important to note that I always ask a specific sequence of questions on the exam. One of the problems on the exam will focus on applying this control sequence, at least the latter part of the control sequence, actually the front part of the control sequence in an auditing context. So again, we need to be able to identify the risk as related to the management assertion, and then identify what would be an implemented control. And once we identify a control, determine a appropriate point of testing. And what did I say about this? I said they all have to align. They have to make sense, okay? So example would be is like you say an implemented control is segregation of duties, all right? Which is going to be an appropriate one in a lot of situations. And I say, how would you test segregation of duties? You say, I'm just going to read the records and documents, Dr. Barnes. And I'm going to look at you and say, really? Which records and documents? And you say, the accounting records and documents, Dr. Barnes. And I'm going to say, which ones? Which ones specifically? And you're going to struggle and you're going to sweat and you're going to say, I don't know. And I say, you know why? Because that's not a test of controls for segregation of duties. That's why. Okay. Appropriate test of controls for segregation of duties would be observation and reperformance, but we'll find that out as we move forward. Okay. So this is where the rubber hits the road. This is where the alignment of all these items more takes place, and it's going to be more sensible here. All right. So let me go ahead and throw this out here. This is one of the most important things for these next few chapters. I am going to give you the numbers for 6 tables over the next 4 chapters. Okay. We do not have the time or resources to review all 6 tables. They're very, very big tables, okay, that relate to this thing right here. The risk, the management assertion, the implemented control, and test of controls. We're going to walk through a few examples. It is up to you to look at those tables on your own. You do not need to memorize anything in the tables. In fact, frankly, I think that would be impossible, okay? I think it would be impossible to memorize the tables. But you do need to gain an understanding of what the content is contained within those tables and understand how everything works together. So for the examples that I'm going to work through are going to be pretty transparent examples, but you do need to look at other examples. This is a requirement for the next exam. You will not do well in this area section of the exam if you don't do this, okay? So this is one that I'm giving you the responsibility. We're not going to be talking about it in class, but I expect you to do this on your own. So our first table is going to be table 10-6. This is first table number 1. Page 351 in the textbook. All right. And basically, this table refers to test of controls related to revenue transactions. So what would be an appropriate assertion related to revenue? What do you think would be our primary assertion? Not our only assertion, but our primary assertion. What is the most big concern? So we talked about this earlier in the semester. Existence occurrence, yes. We're very, very concerned that our client may overstate revenue. So we want to make sure they actually exist. So our assertion is existence occurrence. What would be a risk of this? Okay. Could we say fictitious revenues? Yes. Sales to fictitious customers. Okay. Sales to fictitious customers. So we know the assertion, we know the risk. What is our next step? We want to make sure that the client has implemented a control that relates to this. So what might be an example of control here? Okay. What's my favorite control of all time? Segregation of duties, okay? That makes sense though, because it's very, very difficult to create a fictitious customer or to sell to a fictitious customer if you've got somebody separately recording and authorizing transactions. We just talked about why that's the case here a little while ago. So segregation of duties, okay? So you've identified that they've got segregation duties in place. You want to test the segregation of duties, all right? So what are you going to do? You're going to inspect the records and documents associated with the segregation of duties, right? I just told you, you can't inspect records and documents associated with segregation of duties, okay? That was a trap. It's a trap, okay? What do? We're going to observe the segregation of duties and evaluate that they are proper, correct. So what we would do here is we would observe the process to make sure we gain understanding of it. And our evaluation would probably involve some sort of reperformance. So we would actually take our own transaction and see, how did this transaction flow through this process? And was it properly checked at every single point? Did something that got recorded get properly authorized by the necessary parties? In fact, we've done something like that. Remember our testing back in chapter 6, where we had to make sure that the transaction was properly authorized by a particular supervisor. We had to see the signature on there. That's an example of this type of test. So we want to make sure that we both observe and reperform the tests necessary. What do you guys think? Was that fun? It's a lot of fun, wasn't it? Let's do it again. All right, so we're going to be moving on to cash receipts transactions. So remember, this is a second separate area, okay? So if we're talking about cash receipts, are we still primarily concerned about existence occurrence? I mean, you say cash, you're just kind of like, well, it's an asset, Dr. Barnes. What would be our primary concern? Our primary concern, I think, in this area would be that cash gets recorded or cash gets taken before it gets recorded, okay? So somebody says, oh, look, cash, it goes in my pocket instead of the coffers, okay? So it gets received, but doesn't get recorded. What would that be? Could be completeness because it doesn't get recorded, okay? So we're gonna say management assertion and completeness, cash receipts are stolen or lost before recording, okay? That would be a big risk area. Not, again, that's not the only risk area. Oh, by the way, I glossed over it, bad on me. Here's table number 2, 10-7 on 355. So we've got 2 tables now. Got 2 more tables coming up on Wednesday, okay? I'm gonna throw all kinds of tables at you. Call me a professional wrestler. Yeah. All right. I don't know where that joke came from. All right. So completeness, cash receipts lost or stolen before recording. All right. So we've already seen a control like this. What would be a great control for making sure that cash receipts don't get stolen or lost for recording? Our friend Bill Baumgarth actually did a test over this control back in chapter 7. Does anybody remember that? The coffer test? The bank lockbox? Remember the lockbox control? Yeah. We can actually say use of a bank lockbox system. So transactions, cash transactions get sent directly to the bank, not to us. Okay, so if cash transactions are receivable, like we can actually receive cash, then it goes to the bank instead of being recorded on our client side. So what are we going to do here? Well, we're going to acquire management of bank lockbox policy, bank lockbox policy. That's our first step, by the way. That's an intuitive test of control. Okay, it makes sense. That's exactly what Bill did, by the way. Was that the only thing he did? So Dr. Barnes, it's been several weeks. I don't remember any of this information. You got to remember, okay? This is Mike asking you to remember. If you remember, he inquired, but then he did a reperformance test again. He actually made sure that he saw what was going on with the exception report and that it was properly followed up upon. So he actually did a reperformance test and then he did follow-up tests as well. So this is not the extensive test, but if I asked you this question on the exam and you said inquiry of management, that would be sufficient for the time being. In the real world, inquiry by itself is not going to be sufficient. Why? Because it's a low reliability test and it requires corroboration. But again, I'm looking for making sure that you can identify appropriate tests in this area, not necessarily exclusive test. All right. Now we have test of controls over sales returns and allowances, and we're going to not talk about this. And the reason why is because sales returns and allowances generally is not a material account area for most organizations. So we're not concerned about controls in this area. The one thing I'm going to talk about here is that we generally would have a few controls that we look at. I would not hold you reliable for memorizing these. It's unlikely that I'll ask a question in this area, but I do want to caution you. If we as auditors went to a client and we saw that this client had problems with sales returns and allowances and it was a material amount, that would be an area of concern for us. We're only going to be not concerned about this as long as it's not material. becomes a large amount, if there's a lot of sales returns allowances, we say, what's going on here? Are you making fictitious sales and then recording this as revenue and then getting a lot of returns back? That doesn't make sense to me. So that would be an area of caution, but only if it's going to be material. Okay, let's talk about substantive testing. So we have our substantive analytic procedures and tested details. And again, remember that when we move on to substantive testing, we also incorporate our account balances transactions. This is going to be our primary area of emphasis for our substantive testing. We still will consider transactions and events, but we're going to shift focus towards account balances, which makes sense because at this point, we're trying to make sure that the information in the financial statements is accurate. And we're going to focus very heavily on the balance sheet side. We're going to focus on accounts receivables testing. So real quick, when we talk about substantive testing, how effective do you think substantive testing is going to be for revenue accounts? Well, if we're trying to develop an expectation, it's going to be very, very ineffective in most situations. Remember the analytical procedure we did back in chapter 5 where we tried to develop a revenue expectation? We had this really complex revenue analytic and we came up with a result that was not even in the ballpark of where we were expecting. Usually models are not effective. That being said, we can rely on ratio and trend analysis to some degree. And that's basically what this next slide says, okay? Oops, sorry, next slide said it's like example, a comparison of gross profit percentage to previous year's data may provide evidence on unrecorded and fictitious revenue if it's significantly different. So there's a table in the book that you can take a look at. My claim is that the areas where analytical procedures is going to be relevant, they're very, very obvious. Looking at trend analysis of the accounts, seeing how they've changed over time, looking at financial ratios to see if they give us any evidence. Those are things that you learn back in 221 and learn your finance classes. The areas where it's not effective are going to be the complex areas, and we don't need to spend a whole lot of time. We can actually talk about our analytical models in other areas where they're going to give us a lot more assurance. So for the most part, this is going to be a low assurance procedure area for revenue process. We will not rely heavily on analytical procedures. All right. For substantive tested details, what are some examples of these that we would do here? Well, let's go ahead and let's look at some assertions. I am running out of time. I like to chat way too much. Okay. All right, so let's go ahead and talk really quickly about completeness, okay? So completeness, what would be an example of a substantive tested detail here? It's going to be accounts receivable transactions have been properly recorded, okay? Our accounts receivable transactions have been properly recorded. Now, you may say here, Dr. Barnes, why are we focused so much on accounts receivable and revenue? We're actually going to talk about that a little bit more once we get to a later chapter. Once we get to, I think, chapters 14 and 15, we're going to talk a little bit about why we focus on balance sheet versus revenue. For right now, you should know that when we're talking about account balance emphasis, we usually test the accounts receivable balance, not the actual revenue balance. They are related, but we don't test both. But we'll get to that here a little bit. Existence occurrence. This is very important. Why is this very important? Because we've already said that revenue is at significant risk for overstatement. So we want to make sure all revenue transactions are properly stated. So the account balance is not overstated through the inclusion of fictitious customer accounts or amounts. All right. This is going to be one of our areas of emphasis, and we've got a very, very effective test in this that we're probably not going to get to today. I'm going to have to bring it up on Wednesday. But trust me when I say that we're going to get into that. Valuation allocation. Accounts receivable are recorded. Their net realizable value and the allowance for uncollectible accounts is adequate. Does everybody remember what I said about the allowance for uncollectible accounts? When it comes up in this class, it's referring to which assertion? VAA. We're going to see a lot of that, by the way. We're going to see a lot of that. When you see allowance for uncollectible accounts, you say, this is probably something about VAA, isn't it? Okay. That's every scenario I've ever looked at in this class has to do with that, which makes sense because it's very easy to misvalue that particular area of finance or the area of the reported. Rights and obligations. All accounts receivable are owned by the entity. Is it possible for an organization to sell their accounts receivable? Yeah, it's called factoring. Okay. If you sell your accounts receivable, do you have the ability to collect that in the future? No, if you sell it, you give up all ownership of it. So this is an area that we want to focus on for our organization. Presentation. All necessary disclosures have been made. Classification. Identify and classify any material debits contained accounts receivable. If they're very, very large accounts receivable debits, then they shouldn't be classified as accounts receivables because accounts receivable by definition should not be significant amounts, not material amounts. Material amounts may represent ownership interest or something much larger if we're talking about them from that context. So we may want to reclassify them into investments, particularly if they're really, really large. Also, separate short-term and long-term receivables. Does an organization have a reason why they might want to classify something as a short-term receivable versus a long-term receivable? Are there financial ratios that relate to current assets? Yes, okay. So if we have something that's a long-term receivable and our organization, our client reclassifies as a short-term, then they may be trying to overstate their current assets for covenant purposes. We also want to make sure that different types of receivables are properly classified. And then cut off, all revenue transactions are related to accounts receivable are recorded in the proper period. This is going to be a very simple, straightforward concept, but it's a very important test to make sure because this actually covers that channel stuffing and bill and hold sales issues that we talked about before. And by the way, you'll have homework that's going to test specifically cut off. I'm not going to get to the end of the slides. We'll talk about that. We'll start on the beginning of the slides, these slides on Wednesday. Unless you guys want to stick around for another 20 minutes. Just joking. Okay, see you again. It's